Hello everyone, welcome back to Swadhyay. In the previous video, we have completed revision of heads of income. So now, let us head to the next chapter, that is income of other persons included in assessee's total income. So, what does this chapter deal about? This chapter is mainly concerned with clubbing of income of assessee with income of other persons. An assessee is generally taxed in respect of his own income. However, there are certain cases where an assessee has to pay tax in respect of income of another person. When income of an other person is added to total income of the assessee, it is called clubbing of income. Some taxpayers have a tendency to divert some portion of their income to their spouse or minor child to minimize their tax burden. In order to prevent such tax avoidance, clubbing provisions have been added. They have been incorporated into the Act, under which income arising to certain persons like assessee's spouse or minor child etc. have to be included in the income of person who has diverted his income for the purpose of computing tax liability. So when assessee tries to divert his income to his spouse or minor child so that he can reduce the tax burden, the clubbing provisions will ensure that such income which has been diverted will be clubbed with the total income of the assessee and will be taxed. The first section in this chapter is section 60. It talks about transfer of income without transfer of asset. Here, instead of transferring the asset, the assessee is transferring the income arising on such asset. When income from an asset is transferred instead of asset, such income is clubbed with the income of transferor itself. So it will be taxable in the hands of transferor assessee. For example, instead of transfer of house property, an assessee transfers the right to receive rent on such property to his spouse. In such a case, the income, the rent received on such house property will be taxable in the hands of assessee, the transferor assessee itself, after clubbing such rental income with his total income. It is immaterial whether the transfer is revocable or irrevocable. The next section is section 61. It deals with income arising from revocable transfer of assets. All the incomes arising to any person by virtue of a revocable transfer of assets is to be included in the total income of the transferor. In case of revocable transfer of any asset, the income arising on such asset will be included in the total income of the transferor himself, and it will be taxable in the hands of transferor. Section 62 is an exception to section 61. Section 62 is concerned regarding exceptional case where clubbing provisions are not attracted even in case of revocable transfer. Even when the transfer is revocable, clubbing provisions are not attracted. Section 61 will not apply to the income arising to any person if the transfer is not revocable during the lifetime of the beneficiary, either by way of the transfer might be either by way of trust or otherwise. In spite of being a revocable transfer, such transfer is not revocable during the lifetime of beneficiary. In such a case, section 61 will not apply and the income arising on such asset will be taxable in the hands of transferee. Instead of transferor, the income arising on such asset will be taxable in the hands of transferee. When in spite of being a revocable transfer, the transfer is not revocable during the lifetime of the beneficiary. So during the lifetime of beneficiary, the transfer cannot be revoked. Only in such cases, clubbing provisions will not apply. The income on such asset will be taxable in the hands of transferee only, provided the transferor derives no direct or indirect benefit from such income. The income will be taxable in the hands of transferee only when the transferor derives no direct or indirect benefit from such income arising on the asset so transferred. Otherwise, if the transferor derives any benefit directly or indirectly from income of such asset, income arising on such asset, then such income is to be included in the transferor's total income, even though the transfer may not be revocable during the lifetime of the beneficiary or transferee. So this is what section 62 is all about. Since we are talking about revocable transfer, the meaning of revocable transfer is defined in section 63. Transfer is deemed to be revocable if it contains provisions for retransfer, either directly or indirectly, of either whole or any part of the income or assets of the transferor, or if it gives the transferor the right to reassume the power directly or indirectly over the whole or any part of the income or the assets. The transfer will be revocable. It is deemed to be revocable if it contains provisions for either retransfer or right to reassume power by the transferor over the income or assets, either directly or indirectly, over the whole or any part of such income or assets. When the transfer contains provisions for retransfer or right to reassume power by the transferor, it is deemed to be revocable transfer. I hope it is clear for you. Now let us head to the next topic. The next topic is income of other persons includable in the individual's total income. The other persons here are the spouse of the individual, or the son's wife of individual, that is daughter-in-law of the individual, or minor child of the individual. There are three cases. The first one deals with clubbing of income of spouse. Let us see the cases where the income of spouse is clubbed with the income of assessee individual. Let us go through them one by one. The first case is remuneration in cash or kind to spouse from a concern in which the individual has substantial interest to be clubbed. First, let us see what means substantial interest. What is the meaning of substantial interest? For a company, if the concern is company, if individual is having any substantial interest, it means the equity shares carrying 20% or more of the voting power are beneficially owned by such assessee or individual, or such 20% or more voting power is partly carried by such assessee and partly by one or more of his relatives at any time during the previous year. If either assessee on his own carries 20% or more voting power, or he beneficially owns such equity shares of the company, or when he along with his relative, any of his relative, combinedly carries 20% or more of voting power. In such a case, the individual is said to have substantial interest in the company. For other concern, if such person is entitled, or such person and one or more of his relatives are entitled in the aggregate to receive 20% or more profit of such concern at any time during the previous year. For other concerns other than companies, at any time during the previous year, if assessee himself on his own individually, or assessee along with his relatives, is entitled to a profit of 20% or more, if he is entitled to receive profit 20% or more of such concern, in such a case he is said to have substantial interest in such concern. Relative includes husband, wife, brother or sister, or any lineal ascendant or descendant of such individual. So now we know the meaning of substantial interest. Let us go back to the provision. Remuneration in cash or kind to spouse from a concern in which the individual has substantial interest to be clubbed. All such income which arises directly or indirectly to the spouse of such individual by way of salary, commission, fees or any other form of remuneration, whether in cash or kind, from a concern in which such individual has substantial interest shall be included in the total income of such individual. When an individual assessee's spouse earns either salary or commission or fee or any other form of remuneration, it might be in cash or kind, such income is earned from a concern in which the assessee is having substantial interest, then such income will be clubbed with the total income of such assessee, of such individual. But clubbing provisions will not be attracted if the income to the spouse is solely attributable to the application of his or her technical or professional knowledge or experience he or she possesses. If such income is earned by the spouse by using his or her technical or professional knowledge or experience, such income will not be clubbed in the hands of the assessee. Such income will be taxable in the hands of spouse himself or herself. There might be a case where both the husband and wife have substantial interest in a concern. In such a case where both husband and wife have substantial interest in a concern and both are in receipt of income, either by way of salary or etc., any income is earned by them from such concern, then the income will be includable in the hands of that spouse whose total income, excluding such income, other income, is higher. We have to keep aside the income earned from the concern. The other income of the assessee and his spouse should be seen. When we see that, we have to see whose income is higher, and whosever income is higher, we are going to club this concern's income of both husband and wife to such person whose other income is higher. I hope it is clear for you. The next point is, where any such income is once included in the total income of either spouse, income arising in succeeding year shall not be included in the total income of other spouse unless the assessing officer is satisfied. If in 1 year the income from the concern is clubbed with the total income of husband, in the next year the income from such concern cannot be clubbed with the total income of the wife. It should be clubbed with the total income of husband only. But if the income has to be clubbed with the other income of total income of wife, then the assessing officer has to be satisfied. The next case, where the income of spouse will be clubbed with the total income of assessee. Income arising to the spouse from an asset transferred without adequate consideration. Here the asset is being transferred without adequate consideration, and on such asset income is arising. The first case might be the transfer of asset other than house property. Any asset other than house property, when it is transferred otherwise than in connection with an agreement to live apart, any income arising on such asset is clubbed with total income of transferor spouse. Here the asset is being transferred which is not an house property, and any income on such asset will be clubbed with the total income of transferor spouse if the transfer is otherwise done in connection with an agreement to live apart. If there is an agreement to live apart, and in such agreement, as part of such agreement, in connection with such agreement to live apart, the asset is being transferred. In such a case, the income arising on such asset will not be clubbed with the transferor spouse, but it will be taxable in the hands of transferee spouse. The second case, where the transfer of house property is taking place, otherwise than in connection with an agreement to live apart, then the transferor spouse shall be deemed owner of the house property, and its annual value will be taxed in his hands. We have come across this point, deemed ownership, in section 27 when we are discussing the chapter income from house property. So when the transfer of house property takes place otherwise than in connection with an agreement to live apart, the transferor spouse shall be deemed owner of such house property and its annual value will be taxed in his hands. But if there is an agreement to live apart and in connection with that agreement, the house property is being transferred, in such a case, transferee shall be liable to pay tax on income arising from such house property. On annual value of the house property, transferee has to pay tax. Third point, income from accretion of the transferred asset, not to be clubbed with the income of transferor. The income arising on transferred assets alone have to be clubbed. If there is a house property, the rental income from such house property will be clubbed with the transferor assessee, with the total income of the transferor assessee. Income earned by investing such income arising from transferred asset cannot be clubbed. Let us suppose the rental income after being received by the spouse of the assessee. She is investing in some shares or any other securities. Any accretion, any return on from such shares or securities, the return of income from such investment shall not be taxable in the hands of transferor. Only the rental income will be taxable in the hands of transferor. But when such rental income is being invested by the spouse in some other securities, or it is being invested, the return on such investment will not be taxable in the hands of transferor. It will be taxable in the hands of transferee. That means the spouse. The fourth point, transferred asset invested in business by transferee. Then proportionate income arising to the transferee from such investment is to be included in the total income of the transferor. When the asset which is transferred is being invested by the transferee, any income arising to the transferee from such investment will be proportionately divided, and proportionate income will be clubbed with the total income of the transferor. If such transferred asset is invested in form of capital contribution, the interest on capital, if any, will also be proportionately divided among the transferor and transferee, and the proportionate interest portion will be included. It will be clubbed with the total income of the transferor. I hope it is clear for you. The third case, transfer of assets for the benefit of spouse. Here the asset is not being directly transferred to the spouse, but the transfer is taking place so that the spouse of assessee can derive benefit from such transfer. Then all income arising is clubbed with the income of the individual to the extent such income is used by the transferee for the immediate or deferred benefit of the transferor's spouse. The asset is being transferred from transferor to transferee, and any income arising on such asset, if it is used for the immediate or any deferred future benefit of the transferor spouse, then to the extent such income is used for the benefit of transferor spouse, such extent income only will be clubbed with the total income of the transferor. I hope it is clear for you till here. Now let us head to the next case, the clubbing of income of son's wife. The first scenario is income arising to son's wife from the assets transferred without adequate consideration by the father-in-law or mother-in-law. Here the asset is being transferred to son's wife by father-in-law or mother-in-law for without any adequate consideration. The income from such asset is to be included in the total income of the transferor. If the asset so transferred is invested in the business, the asset is being invested in the business, then proportionate income arising from such investment is to be included in the total income of the transferor. Generally, when asset is being transferred to son's wife by father-in-law or mother-in-law for without any adequate consideration, will directly club the income from such asset to the total income of the transferor. When such asset is invested in the business by transferee, the proportionate income arising from such investment should be included in the total income of the transferor. The second case, transfer of assets for the benefit of son's wife. Instead of transferring the asset to son's wife, it is being transferred so that son's wife can derive benefit from such transfer. All income arising will be included in the total income of the individual to the extent such income is used by the transferee for the immediate or deferred benefit of the transferor's son's wife. If the transfer was for adequate consideration, the above clubbing provisions would not be attracted. Only when there is inadequate consideration, then the clubbing provisions will be attracted. If the transfer has taken place for adequate consideration, clubbing provisions will not be attracted. Then comes the case of clubbing of minor's income. Let us go through the provisions regarding the clubbing of minor's income one by one. All income of a minor is to be included in the income of his or her parent. All the income earned by minor child will be included in the income of his or her parent, whose total income excluding this minor's income is greater. So we have to see if the income of father or mother whose income is greater, and we will add the total the income earned by the minor to the parent whose total income is high. Once clubbing of minor's income is done with that of one parent, it will continue to be clubbed with that parent only in subsequent years. It means if in 1 year minor's income is clubbed with income of his father, every year his income should be clubbed with total income of his father only. Clubbing provisions are attracted even in respect of income of minor married daughter, where the marriage of parents does not subsist. If the parents live apart, the income of child is clubbed in the income of child clubbed in with the income of parent who maintains the child. When the marriage of parents does not subsist, when parents live apart, the child, if whoever maintains the child, the income earned by such child will be clubbed to the total income of such parent who is maintaining the child. The income derived by the minor from manual work or from any activity involving his skill, talent or specialized knowledge or experience will not be included in the income of his parent. Here, when the income is earned by the minor child either from his manual work or from any activity involving his skill, talent, any specialized knowledge or experience, in such a case, we should not club the income earned by the minor child with the total income of his parent. The income of a minor child suffering from any disability specified in section 80U shall not be included in the hands of the parent, but shall be assessed in the hands of the child. If the minor child is suffering from any disability as specified in section 80U and he is earning income, in such a case, we are not going to club such income of minor child with the total income of the parent, but it shall be assessed in the hands of child. So, we are not going to club the income of minor child with the total income of parent in two cases: when such income is earned by the minor from his manual work or any activity involving his skill, talent or specialized knowledge or experience. The second case is when he is suffering from any disability as mentioned under section 80U and still he is earning some income. In these both cases, the income shall be assessed in the hands of the minor child himself or herself. Now let us talk about one exemption regarding minor child's income. In case the income of an individual, that is the parent, includes the income of his minor child, such parent shall be entitled to exemption of either total income earned by the child or rupees 1500, whichever is lower. So when we are clubbing the income earned by the minor child to the total income of the parent, up to 1500 there is an exemption. The parent can claim an exemption of rupees 1500, or if the income earned by the child is less than 1500, such total income. So lower of either total income earned by the child or rupees 1500 will be exempted when the total income, the minor's income is clubbed with the total income of the parent. And this 1500 exemption is in respect of each minor child, for each individual minor child. This exemption can be claimed only if the assessee opts out of default tax regime. Under the default tax regime, assessee cannot claim such exemption. But if he opts out of default tax regime and opts to pay tax as per the normal provisions of Income Tax Act, then only he can claim this exemption. The next topic, transfer of house property without consideration or for inadequate consideration to a minor child. Here, house property is being transferred either for without consideration or for inadequate consideration. In the first case, it is transferred to a minor child who is not a minor married daughter. In such a case, transferor is deemed owner of such property. Hence, any income from such property is clubbed with his total income. The benefit of exemption under section 1032 cannot be availed against such income. When house property is being transferred without any consideration or for inadequate consideration to minor child, and such minor child is not minor married daughter, in such a case, transferor is deemed owner of such property. Hence, income of such property is taxable in the hands of transferor himself. In such a case, in case of deemed ownership, benefit of exemption under section 1032 cannot be availed, since it is not deemed as income of the minor child. If the house property is being transferred for without any consideration or for inadequate consideration to assessee's minor married daughter, the income from the house property will be included in the hands of that parent, whose total income before including the minor child's income is higher. When house property is transferred without consideration or for inadequate consideration to minor married daughter, in such a case, we have to see the income of parents of such minor married daughter. Whosever income is higher, we are going to add the income from such house property to such parent, whosever income is higher. The benefit of exemption under section 1032 can be availed by that parent in respect of the income so included if he or she opts out of default tax regime. In this case, the assessee can claim the benefit under section 1032. He can claim the benefit of exemption under section 1032 if he or she opts out of default tax regime and pays tax as per the normal provisions of Income Tax Act. Under default tax regime, exemption under section 1032 cannot be claimed. Now let us head to the next topic, that is cross transfers. Here I have taken an example which is given in our institute material directly. Let us discuss such case. In the case of cross transfers also, cross transfer means, for example, Mr. A is making a gift of rupees 50,000 to the wife of his brother B. Here A is giving gift to his brother B's wife of rupees 50,000 for the purchase of a house by her, and simultaneous gift by B to A's minor son of shares in a foreign company worth rupees 50,000 owned by him. Here, if any of us will see the case directly, it is considered as a mutual transfer. It means here A is giving rupees 50,000 as in form of gift to B's wife, his brother's wife. Similarly, B is giving rupees 50,000 worth shares as a gift to minor son of his brother Mr. A. In such a case, the income from the assets transferred would be assessed in the hands of the deemed transferor if the transfers are so intimately connected as to form part of a single transaction, and each transfer constitutes consideration for the other by being mutual or otherwise. Accordingly, the income arising to Mrs. B from the house property should be included in the total income of B, and the dividend from shares transferred to A's minor son would be taxable in the hands of A, assuming that Mr. A's income is higher than that of Mrs. A. So, in above case, as per income tax provisions, what we have to do is, any income from the house property purchased by Mrs. B, any income from the house property purchased by Mrs. B will be included in the total income of Mr. B. Similarly, return or dividend from the shares which is held by A's minor son will be taxable in the hands of Mr. A. This is because in the case of such cross transfer, Mr. A and Mr. B are indirect transferors to their minor child and spouse. Mr. A is acting as indirect transferor. So, Mr. A is acting as indirect transferor to his minor son. Similarly, Mr. B is acting as indirect transferor to his wife Mrs. B. Hence, since A and B are indirect transferors to their minor child and spouse respectively of income yielding assets, so as to reduce their burden of taxation, any income from such assets will be taxable in the hands of A and B respectively. I hope it is clear for you. Now let us head to the last topic in this chapter, that is conversion of self-acquired property into the property of HUF. Here, an individual is owning a property and such property is being converted into the property of HUF in which he is member. The personal property of individual is being brought into the business of HUF. The case is where the individual who is a member of HUF converts his individual property into property of HUF or into its common stock. Either they are using such property as asset or it is being treated as common stock of HUF, otherwise than for adequate consideration. The transfer is being taken place, the conversion is taking place without any adequate consideration. The income from such property shall continue to be included in the total income of the individual, in spite of being transferred or converted into the property or common stock of HUF. Still, if any income is being derived from such property, it will be clubbed to the total income of the individual only, not the HUF. Where the converted property has been partitioned, either by way of total or partial partition of HUF, then on partition of HUF, the funds will be divided amongst the members. Similarly, there might be a case where spouse of the individual who transferred such property is also receiving funds from the HUF. The income derived from such converted property as is received by the spouse on partition shall also be included in the total income of the individual who effected the conversion of such property. So, when the individual has converted the property into the property of HUF, and now on partition of HUF, the spouse of the individual is now receiving some income from such asset, from such converted property. Such income will also be clubbed with the total income of the individual and will be taxable in the individual's hands. Since in above two cases, the income arising from such asset is clubbed with the total income of individual who converted the asset, such income shall not form part of income of HUF or the spouse of such individual, as the case may be. Here there is one important point to be noted. As per explanation 2 of section 64, income also includes loss. So therefore, clubbing provisions would be attracted in all the above cases even if there is a loss and not income. In all the above cases, the clubbing provisions, as they are applied to income, similarly they will be applicable to losses arising in above circumstances also. With this, we have completed revision of the chapter Income of Other Persons included in the assessor's total income. Further, let us discuss the next chapters in upcoming videos, and I hope you enjoyed watching this video and it is helpful for you. Please keep watching our videos, and thank you.